introduce you. Okay. Okay. So, good evening, everyone. It's a pleasure to welcome you all to the episode number 5 of Trading Heads web series, a knowledge arena where the minds behind the market decode and demystify and deliver deep insights. Today's session titled Mastering Portfolio Management, a strategic framework for smarter investing, promises to be a masterclass in precision, perspective, and power. We will be enlightened about universe selection across market caps to decode sectorial rotations and macroeconomic tailwinds, harnessing the power of investment factors and to find balance with the risk and return. This webinar is designed to elevate your investing acumen brick by strategic brick. We are truly honored to have Mr. Saurabh Banerjee, MBA and equity analyst at Marathon Trends. Let me tell you all that Atul Suri is the founder of Marathon Trends. He has been associated with legends like Rakesh Jhunjhunwala and Market Wizard at Sikota. With a keen eye or equity cycles and structured approach to portfolio construction, Saurabh brings the perfect mix of theory, practice, and market rhythm. His insights are rooted in data and deep research and are designed to serve both individual investors and institutional minds alike. So fasten your seatbelts and keep your notepads ready because this isn't just another webinar, it's a roadmap to smarter, more resilient investing. So let's dive in. Hi, Saurabh.
Hi, sir.
Hi.
It is a pleasure,
Uh,
likewise. Thank you for having me
yeah,
on the platform.
yeah. So, Saurabh, let's begin with how you started with your market journey, and then we'll go into your presentation.
So my market journey began in 2016 when I first came to Bombay, and I got introduced. So I am not from a stock market background, right? My family or my friends, they have not been in stock market, and you can call me the outlier who just got interested in market and started investing. And from there, after investing in the market as it goes with everyone, I understood it is not a thing which you can be like, buy and hold and many strategies which I have seen on YouTube. It didn't make sense to me that what could be the what could be the outcome here? How can I manage my own money in a better manner? That was my beginning, right?
Right.
So as it goes, I started exploring YouTube and many things. One thing which I saw in common that people who were making sense to me, they had degrees under their belt, right? So there was CFA. I explored CFA first to understand how can we analyze stocks using fundamental analysis. But to be honest, it didn't click with me. Then I got introduced to CMT. Um, I would like to give the credit to Vishal Mehta and Akshay Chinchalkar sir because I got connected with them over LinkedIn, and they were the ones who guided me to Shobit sir. And I think I joined Shobit sir around 2018, right? It was
Yes, I
around
remember.
2018 when I started my CMT level one. And from there, the journey actually began. For me, when I saw the chart for the first time, it was a very new thing. But what I thought that with deeper understanding and with a mentor like Shobit sir, there is a one incident which I would like to share here. Uh, all the institutes I have been before, uh, everyone was promising one thing that within a year you will be able to make what you earn in a month. That didn't make sense to me. I didn't think the market is so easy to crack that I will be able to crack it within a year. My turning point was when I sat with Shobit sir. He explained everything to me that how it, and the point which actually made me that this is the person I should be learning from was that he told me I myself became profitable after 10 years. That gave me a big amount of credibility, and I thought, okay, maybe with proper guidance and proper discipline, I will be able to understand the market. I don't know whether anybody is able to crack it or not, but at least we can understand how the market behaves. So that is how my journey started. And after completing my level one, I started my own sub brokership in Kolkata. I am from Kolkata, so I started there. And after doing it for a year or so, I got introduced to Atul sir. And from there, I would say my actual journey of becoming a portfolio manager began, understanding how portfolio operates. So my point of view shifted directly from how stocks are traded to how to manage a portfolio and how to use macroeconomic, how to use sectorial tailwinds, how to diversify portfolio, how to manage the risk. Because I have always heard Atul sir saying that we are in the business of risk management, and I believe everyone agrees with me that our work here, our job here is to manage the risk, lower the risk of a portfolio so that we are able to enjoy the alpha. So that is a brief about how my journey started, and I joined Marathon Trends in 2022 April, and I am still working here. So yeah, so I think so that encapsulates my journey in the market.
Okay, great, Saurabh. We'll talk about what you learned from Atul later on at the end of this webinar a little bit, if you are okay to share that. But
I think
let's
this
begin.
this itself will give you the idea that what I have learned over the years, this framework. So today I am not here to share any system or anything, but rather what I have learned from Atul sir and Vineet sir also, because he has been a big contributor to my knowledge, and how we can create a framework for portfolio management. So it's not a system that I'm going to share, rather a framework around which we can build our own portfolios.
Yeah, perfect. Saurabh, you can begin now.
Okay, all right. So first of all, I would like to share disclaimer, right? Anything you see here is not a recommendation, and I would just like to give a few minutes to this so that you're able to go through it.
We'll just have a pause so that you can read it,
Yeah,
and
yeah.
then we'll start in a minute. By say 7:10 or 7:11, we'll start again.
So just give me a go ahead, like when I should start with this. Once the disclaimer part is done,
Saurabh, I think you can go ahead.
I can go ahead, right? All right. So guys, let's begin. So the framework, right? The framework for me consists of four elements. First, understanding the universe for selection, sectors for understanding the tailwinds, factor selection, which is basically how you want to analyze the market, fundamental, technical, or quantitative. It can be any. And the most critical part of it, the risk management. Now let's understand the nature of the universe selection. So market cap, what does this market cap gives us insight into, right? First we'll classify, then look at the characteristics of each category, and then we'll get into the risk return profile of the market segments, right? So if you see, I have taken here universe of CNX 500 because more or less 96 to 97% of the market is comprised of falls within this bracket. So for the categorization of large cap, the top 100 is taken, right? It's always the market cap ranked. The mid cap is the next 101 to 250, and small cap is 251 to 500. In our case, sometimes it is taken till 1000, right? Moving on to the characteristics of this. Now, I have to understand which category has the most alpha generation potential. I have used three things. First is the return. So I have taken the data of Nifty 100, Nifty Mid 100, and Nifty Small 100 indexes since May 2016 till April 2025. The reason being we want to compare oranges, right? And the data for small was available since then. So this is what the CAGR return of each category looks like. Now, if we look at the volatility perspective of it, we can see the volatility increasing gradually as we move down the market cap segments. And this is the maximum drawdown which we have seen in March 2020 for each category. This also tells us that as we move down the market cap, the risk profile is increasing, which is very evident to everyone. Right? Now, what is the price behavior of each of these segments? To demonstrate that, I have used a scatter plot of daily returns. Right? What I want you to focus on is this region and the standard deviation here. You will see as we move down the market cap, the clustering of data is spreading out. We can see a loser cluster and the standard deviation increasing. It's quite evident, right? What does this tell us? This tells us that large cap exhibit a pendulum-like mean reverting characteristic. It is not a segment where trend following might work, but I would, what from my understanding and research, what I have understood, a system which is mean reverting will fit this better. So, for example, if you see the last trending large caps have been, let's take the example of Trend, right? Trend has been a multi-bagger, but in the last fall, it has given as much as it has grown. Why? Because what happens is that in the large cap category also, there will be few mavericks who will not behave according to the characteristics. But the mean reversion is such potent in this segment that it has to come back to the mean. And that is what we see with trend also. Mid cap and small cap exhibit a trending characteristic, and thus we sometimes see these are choppy. Now, to demonstrate it further, if you look at the returns of weekly returns, you can see this is center concentrated. The data is forming kind of a bell-shaped curve, right? I'm not using any discrete intervals for this. If we look at Nifty mid cap, we can see the data spreading out. The center concentration is not as such, which tells us that there is long tail, and long tails are what we require for alpha generation. Right? This is for the small cap. Now, how does this help? So, if we understand how the money flows between market cap segments during different economic phases, and we do a historical analysis of the market cap rotation during each bull and bear market phase, we will be able to use this matrix for signals for tactical allocation of assets, right? How we'll see that in the coming slides. And they also help us with risk management through market cap diversification. So if you see, what I have done here is that I have made a NAV by taking the returns of these three segments. Right? If we start off with 2016 as the data was there, if you see here in 2018, SEBI came ahead and told us about the segregation of these market cap, and we can see how the large cap is prevailing here, and there was a small cap and mid cap bear phase, right? And this is telling us. Then again, when the COVID came, we can see large cap rising. So this is the general characteristic of the market, that when it enters a bear phase and it is coming out of a large to a bullish phase, generally the large cap, generally it's always a probability, it's not for sure, but generally the large caps will prevail, then the mid cap follows, and then the small cap starts. But if you see here, it's also evident that the most alpha generation which could be done is in this mid cap category, right? So by simple analysis of the ROC, the returns rate of change, we can ascertain that what kind of returns we can expect, who are leading segments, who are losing segments, and what segment will help us in which kind of risk management. So for that, let's look at this. So if you look at the risk return profile, you can see the most balanced one is the mid cap. The least risky is the large cap, quite obvious. And the most risky is the small cap. Does it mean that we don't have small cap in our portfolio? No. It means that we manage the risk better in these two sectors and use this segment for stability. Now, this is not a recommendation. I have just used this for construction, just to showcase the construction of a portfolio, right? It is not ranked, nothing done, just simple examples. So if you try to create a 20 stock portfolio, right, and you take 5 stocks from each segment, you're left with 5 slots. Now, what we can do, going back to a chart like this, is that if we understand which sector is outperforming the other one, we can allocate our portfolio accordingly, right? There are different metrics and measures to that. This is just a simple example I'm using here, but it will help us understand if we placed, let's for example say, if we had placed our rotated our allocations to the large cap in this phase, it would have performed better. The portfolio would have been much stable, right? If we would have allocated our capital in this phase for mid cap, we would have made the most alpha. Now, coming back to this, what we can understand is that market cap is something which where the allocation of the portfolio will define the alpha generation capability of it. Now let's get into the sectoral tailwinds. So what does this help us with? So you see, sectors don't move uniformly. They respond differently to different economic conditions, but it do create opportunities for investors who understand these patterns. How? So here, what we have done, this is a proprietary ranking mechanism of marathon trends. What we do is we have taken 43 sectors, custom sectors that we have built, and among them, I'm showing you the top 30 sectors. Right. This is the ranking of 9th May in the first column. These are the industries, and these are few inflection points which have happened recently. Right. If we go back in time, we can see that defense industry was doing at 3. Now it may be at rank 1, but it was at 3 in December. Going back to the September phase where the market bearish phase has started, it was at 18. And when the PSU rally ended, when the PSU rally ended, it was again at 1. So you can see how between these quarters the ranking of this sector has changed, right? This is clearly, we can see it here. And you can also see how lagging sectors have come up in ranking. Tires were at the bottom in these rallies, but now it is ranking number 2. So what does this tell us? This shows us how can we rotate between sectors to diversify the risk of a portfolio, right? But for that, what we need is to understand which sector is outperforming the Nifty 500. So in our case, if you are trying to build a flexi cap portfolio, a suitable benchmark is Nifty 500 because it encompasses all the sectors within it. Now, this also tells us not only the ranking which sectors is outperforming each other, it also tells us which sector is outperforming the market as well, right? So this is how we use these parameters to build our portfolio. So there is something, the concept of leaders and laggards. So within each sector, not all stocks perform equally, right? There will be sectors which are coming up, but there will be map leaders, which will be like 1 or 2 leaders among them. So for that measure, what is important is that we analyze the relative strength of sectors against broader market indices and analyze the breadth matrix to assess sector health, to understand whether the momentum which we can see in the ranking is persistent across the sector, or is it just a fluke that 1 or 2 moves are creating this, so that we are able to allocate our portfolio to these sectors accordingly. Now moving on to factors. If you see here, the factors have a shelf life, right? So I have defined low volatility, momentum, alpha, quality, and Nifty 500 is there for benchmarking and value. But you can see across the timeline, there is no one factor which has been at the top. It is always a thing which is linked to market regime, how the market behaves, what phases the market is going through. That is how the shelf life of a factor will operate. We cannot say that we build a momentum system and that momentum system is going to prevail in every kind of market conditions, which is very evident from this chart. Now, these are few of the conditions which we use, but the point which I'm trying to make here is that there is no holy grail. There is no holy grail in the markets. There is no one factor which will work in every market regime. And that is why it becomes very important for us as portfolio managers to understand how the market caps are moving, how the sectors are rotating in their leadership, and which are becoming laggards, so that we are able to eliminate them from our portfolio and include the leaders in our portfolio. Moving on, I will share a simple construction process that how can we use and combine all these matrix. Right? So first, in our process, we start with quality. That is basically fundamental analysis, doing a top line and bottom line analysis of the company. So few metrics which we use is first we define the market cap, the segments which we want to be in, right? As I have already shared with you, you can see how we risk profile the market cap segments. Then we get into the sales analysis, how the top line is growing. Then we also look at how they are materializing in the down, in the bottom line. And then we also look at the valuations factors, right? Are the stocks overvalued? Are the stocks undervalued? Are they fitting into the regime that the current market is going into? Is the portfolio going to be suitable for a high valuation stock or a low valuation stock, dependent on the regime of the market? Then this is my favorite part, being a technical analyst, right? I have worked mostly with technicals. So we use technicals for timing the entries and exit, not the market, but the entries and exits. How we do that? So for me, technical analysis, I saw technical analysis in two ways. One was the pattern recognition part, another was the objective technical analysis. So me being a like not having much experience in the market, it made sense to me that backtesting or simulating market with these factors is something which will tell me, which will give me that what do you call the experience in the market, right? After looking at hundreds of simulations, you do understand how these factors of momentum, how the factors of trend, how the factors of volatility are going to play out, and that gives you an experience which can be gathered really soon. Like that has been my understanding, and I was blessed enough to have a mentor like Shobit sir, who actually introduced me to the objective technical analysis side. So for me, I divide technical analysis in three aspects: momentum, volatility, and trend. Momentum is something which I use for alpha generation. But if you remember, I have already told you that large cap is a mean reverting large cap has a mean reverting characteristic. Right? So what we have understood from our research is that stocks work well with momentum. Any system that ranks stocks on basis of momentum does well than any trend following system. I'm not saying that trend following system don't work. I am saying the profile, the characteristic, the behavior of the price suits mean reverting system for large caps, and mid caps and small caps, as we have seen, they have long tails and have the most alpha generation capabilities. They work really well with trend following momentum system. So what we do is we evaluate and rank based on momentum, valuation, and the screening process which you have seen. Right now, I use momentum for ranking. Trend is used for our understanding of direction. As a PMS, we are always long only. Right? Shorts tell us when to lower our allocation, how, when to go into large caps, when to get into cash, these kind of things. But I feel my research has shown, and many texts also tell that trend following systems work the best in commodities. and momentum systems are well suited. Like, I think there is a book called Stocks on the Move where I got the idea from. And after doing many simulations, I have found that any system which is based on momentum will work well in the market. But do realize that momentum systems have a downside. Momentum systems will catch stocks in their third or second phases, and they will be quite high, quite far from their 52-week lows, or let's say lifetime lows, and thus the risk is also higher. So that is why a volatility profiling or risk is very important here, and we should also have stop losses that prevents our capital erosion. Then how do we combine it, right? All the points which I have talked about so far, how do we combine it? So this is the aspect I combine all these aspects to manage one thing, which is risk. So the market cap helps us with allocation of capital and rotational triggers also. Like the chart which I have shown you before, we do analysis, some proprietary analysis is there with which we can find which are the triggers to allocate our capital. Sector is used for diversification so that we are not concentrated within a sector, so that when the tailwind change, we are not getting a systemic risk or the sectoral risk, right? By being concentrated in a single sector, to diversify the portfolio across. Also, it helps us with rotation and factors. Factors helps us with picking leaders for entries and selling laggards, right? So this is how the portfolio framework works. It cannot be only dependent on factors. It has to uh, it has to materialize market cap, it has to materialize sectors also. Without the macro overview or the understanding of what the systemic risk is, a portfolio manager cannot really diversify the risk along these baskets. That being said, I think mostly we have covered the aspects of the framework of a portfolio management. And thank you for your time. Right. Shobit sir, over to you. I think if there are any questions.
Yeah, Saurabh. I think it was a good presentation, Saurabh. Especially a few things which I got to understand from this is that, firstly, your information that mid caps are the best sectors to invest in, right? Because they have lower risk than your small caps, and
Balance,
they have
yeah.
a higher risk profile, sorry, return profile, right? So that was one great insight. Another thing what I learned from this is that uh, your sector rotation, that five factors which you took, right? It was like they all are changing from being the best to the worst. Like, I think you took five factors, right?
I think you're
Alpha,
talking about this slide, right? Just a
yeah,
minute. This one.
alpha, value,
Okay,
and
so that was a part of the factor,
yeah,
right?
this one,
This
yeah,
is
low
this one.
volatility, momentum, alpha, and quality and value, right?
Right.
So you have defined into five, but I think you were saying when we talk that there can be many.
There can be many, sir. It could be a mix of value and momentum. It could be a mix of low volatility with alpha. So uh, factors could be many. We can distribute them among, like, let's for example, let's say mm, I have allocation in large cap and I have allocation in mid and small. Right? So I can also diversify the risk of a portfolio by using two systems to trade or invest them. I would use a mean reverting system for the large cap and a trend following momentum system to generate alpha from the mid cap and the small cap.
Right.
That could be also a thing. But what we need to understand is to how to segregate these things, how to segregate the information input which are getting from market cap, how to segregate the information input which we are getting from sector, how we are segregating this with the factors. Because when it comes to factors, you can select anything. For momentum, we can use RSI, we can use ROC, we can use stochastic. There are plethora of indicators, but what is more important, if I recall, there was a chapter in CMT level 2, Making Money or Being Right. It was by Ned
Right.
Davis. And one concept which stuck with me there was system designing shouldn't be like throwing something at the wall and seeing what sticks. Rather, it should come from the deeper understanding of how the price behaves, the segment behaves of that, the price behavior of that segment, and then apply factors accordingly. That way, what happens, you cannot over optimize or curve fit your systems, right?
Correct.
There is a possibility still. I
Yeah.
would say there is not a possibility we can overfit, we can curve fit a system. But if we come from an understanding, a general understanding of the price behavior of that particular category or segment, the systems which we build with the factors will be much superior and robust.
Right. Right. And another thing, what you talked about that your I forgot this say mean reverting works well in mid cap, sorry, large caps, and mid
Right,
caps and small caps work better in trending formation or momentum formation, right?
right,
So
right,
that was again a great insight, which I have already known that, but never given too much attention to it, right? So it was a eye-opening for me again when you showed your presentation. So so basically, what we can do seeing this presentation is that we can take trend into consideration of these large caps and maybe make a strategy which is more of a retracement based strategy which will mean revert because these large caps tend to follow the trend also and tend to mean revert also, right? So
right,
something like take the longer term trend, go with that trend, and then have a retracement based strategy where there is some bit of a correction in the trade in the stock, then you enter into that stock, right?
right,
And for mid cap and small caps, basically you can use something like momentum using ROC, RSI, those strategies. That way, you will have both the elements into your system, that you have mean reversion also in your system, and you have trend following also in your system, right?
right.
And that is what we always suggest, that have a mean reverting system in your portfolio and have an uh, trend following strategy in your portfolio, right? So that way, basically, you are telling that exactly that to be done, right?
So basically, what you said, sir, if I can conclude, the thing is that what you just said, the main key word here is to diversify, right? But also to know when to stop. Over diversification is not going to help because then you
Right,
lose on the potential of generating alpha. What we need to understand is how much to diversify and where to stop. That is a crucial thing, right? You can diversify across market cap, sectors, factors also using systems, but there will be a point where the strategy will start getting overcomplicated, right? So
correct.
it is also a key factor to keep it simple. Sorry, sir. Just can I just have 1 minute? I will just plug in my this thing.
Yeah, yeah, sure, sure.
Just a
Power,
second.
right? Yeah, yeah, sure. Okay, audience, if you have any questions, you can ask in the chat box, or maybe we can give you the authority to speak also with Saurabh. So you can unmute yourself now. You have the rights. You can ask question directly, or you can put it down in the chat box.
Sorry for the interruption. Yeah,
No issues. Yeah.
I think there
Okay.
are a few questions in the chat section.
Yeah. Uh, I think most of the questions we have already replied. Only thing is, Vivek is saying fantastic session by Saurabh sir. Really appreciate his efforts for sharing his insights. Suryas is asking, can you explain factors and regime again?
Factors and regime. Which part would you like to understand? Yeah. So my question is to this was Suresh, right?
Suryash, yeah.
Suresh, yeah. So what part would you like to understand about this? You can be a bit specific.
Suryash, are you able to hear us? You can write it down in the chat box, or you can ask,
Yeah, yeah,
unmute
yeah.
yourself and ask. Raju is asking, how do you rank sectors?
Well, to give you a clue, you can use yeah, you can use momentum. You can use volatility or a mix of momentum and volatility, or you can see how you can which are the sectors which are outperforming. Basically, relative strength could be another thing. So this is a proprietary one. I couldn't be sharing the exact thing, but yeah, it's quite easy. It's quite easy to do.
I think exact rules are not important here. Saurabh has shared a framework with us, and I think it's a great framework because it is telling us everything what we will be needing, right, to make any strategy, right? We don't exactly need the rules to say identify the momentum or the trend, right? We already know, being
If I
most of
if I
us being
define the factor, like if I define the factor again, if I go back to that slide, my point here was that there is no holy grail. I It's not upon me to tell you a indicator or a factor which will work in all the market conditions, which is very evident from this slide which we are looking at, right? So what I am trying to specify or entail here is that it is important to diversify, because diversification will give us the protection along with the alpha generation, because what is going to work in the next phase of the market is not known to anyone, right? Nobody can predict. There is no predictive analysis here. What we are trying to do is we are trying to just follow the trend at the end of the day, but we are trying to drive that with data rather than being discretionary. We are making it a decision science, right? Now, I can tell you all the factors, you can try them out, but the point here was to share a framework of constructing a portfolio, which is quite evident from here, that what are the ingredients which you require, the basic ingredients which you require to create a diversified and a well allocated portfolio, and how to rotate them across industries, right? That was the main idea here.
right. Okay. Suresh, can you say give it a little bit of a detail of what you really want to understand from factor and regime, or maybe sort of you can elaborate little bit more about these factors, like 5 factors which you have taken here.
Okay,
Okay, just give a
let
little
me get
bit of
into
a
that.
elaboration of that.
Right, right. Let me get into that. So, see, by regime, I mean what kind of phase the market is currently going in, right? Regime would be defined by volatility also, because that is one metric which is like a quantitative measure. And volatility, like you can use a simple ATR to define what kind of regime the market is currently going into. Because regime shifts are the things which are going to affect the shelf life. The chart which you see here, sorry, the chart which you see here, see, if you notice, in 2008 low volatility worked, right? Low volatility came out as the best. Why value came second, quality came third, nifty, let's not talk about nifty. Momentum was not the one which was, but as the trend started rising, right, this is where the trend started rising. You can see the momentum dropped from the first position to the second last to bottom, and come 2009, the best bull market, right, we have ever seen, it started climbing again, and then again this it became stable, right? Stable again, it started falling, again it went up. So what is this telling us is that no factor, no momentum factor or ATR. Like I can tell you, like use RSI 70 or use ATR and make our system out of that. It's not going to perform in every market condition. So first, what we need to understand is that what kind of market conditions we are in, which can be easily understood by doing a simple chart analysis. This analysis itself is telling us which are the sectors and how the markets are behaving. In a bull market, you will always see these two categories rising above the large cap. In a bear phase, you will always see the large cap outperforming these two categories, which you can see here, right? But again, this is market. It rhythms. It doesn't like there is a rhythm to the market, but there is no rhyming. It is not going to be exactly the same. Like if we look in the recent past, when every correction happened, large cap was not performing, right? Even large cap was thrashed. Why? Because the market is never going to rhyme. Rhythm. It always has a rhythm. It's not going to be the same. Similar, but not the same. I cannot say for sure that this is what is going to happen. But more often, you will be right. That is what the edge comes from. Right? That is where the edge is coming from. That more often we will be right. And when we are wrong, what we do? Most important question being is what we do when we are wrong. Do we cut our losses? Are we getting out of the laggards soon enough and rotating our money so that we are getting into opportunity faster? That is what is going to define the alpha generation capability of a portfolio. So I would rather compel the participants to focus on understanding price behavior, market cap behavior, sectoral rotation, then focusing more on factors, because factors are just methods of analysis. It could be anything, technical, quantitative, fundamental. But what is eternally true about the market, which has not changed and which will never change, is going to be market cap and sector. Sectors will rotate, market cap will outperform and underperform each other. That is going to be there forever, right? But no factor is going to be the best. There is no seasonality which we can decipher from this data, that we can say, okay, let's put this factor which is going to work out, right? In like here, low volatility worked, but here it's in the second position when the COVID bottom came, right? So what we need to understand is this factor is something which we fit with the market cap and the sectors that we are allocating our portfolio to, right? Rather than looking at from a bottoms up approach, let's look at it from a top down approach, where we first understand which category we are in, then we understand what sectors to diversify our portfolio across, and then we choose how to get into them, how to enter, how to exit. Factors help. Sir, simple सी बात है, like market is like अभिमन्यु का चक्रव्यूह, right?
Right.
Factors are for timing the market, entering and exiting, right? But factors cannot tell us which regime we are in. Factor cannot tell us which segment of the market cap is performing. By that I mean the market cap, and it cannot also tell us which sector is going to be the leader, the next leader. But if we do an overall analysis, we will be informed that these have been the leader. And over the years, with this kind of analysis, you will get a gist of the market that will tell you preemptively, maybe it will become a gut feeling that data has shown me this, and this is what I can expect. Does it
Right.
answer the question?
Yeah, more or less, yes. Uh, Another thing that in this slide you have put some numbers behind these, right? So, what are these numbers?
These are
If you can,
basically returns of the
okay, return of that
category. Yeah.
category.
Return of
Okay.
this category.
And when you say alpha, what do you mean by alpha here?
Alpha would be mostly categories where we have invested in mid cap and small cap.
Okay. Okay. And when you say quality, quality is like the large caps.
Quality is not only large caps, but rather companies which are fundamentally also sound.
Okay, so you have segregated your entire 500 universe into these five categories, right? So low
How we do it
volatility.
is this
Yeah.
filter helps us to segregate them, right? This tells us about the quality. That is why I mentioned it here. This tells us about the quality.
Okay. So those stocks we filter all the 5 categories or 4 categories here will qualify as quality, right?
So for example, I am not using all the 5 factors simultaneously, right?
Right.
What our portfolio is primarily is it's a mix of momentum and value.
Okay.
What we try to do is, because our strategy is mostly a mix of momentum and value, we try to see which market conditions it is going to fare better, and we allocate capital accordingly. We rotate the large into large caps and mid caps accordingly. That is what we do.
Okay.
So all the factors which I have mentioned in this slide, I'm not having all the, what I'm trying to showcase here is that how they have behaved over the market phase. Right? This
Okay.
this entire slide is to prove that there is no holy grail.
Yeah, fine. But how are you defining low volatility has given this much return, momentum has given this much return? How you have defined that?
So so I construct, let's say I construct a portfolio where I see I use ATR for low volatility. I'm just giving you an example,
Yeah.
not getting into deep.
Right.
Right? I
Yeah.
use a let's say I use a ATR profile for understanding which are the stocks that have the least volatility, or I use a standard deviation matrix to define which stocks are the low volatility. And definitely in a bear market condition, or the market where the markets are choppy, I can expect, this is again a probability, I can expect a low volatility portfolio will do better. And then we put on the general backtest of it, right? And that is how we define low volatility. It's quite simple. It's not a very complex thing that we have done here.
Okay. Fine. Yeah, Vivek, you can ask.
Yeah, hi, Saurabh. Can you hear me?
Yes, I.
Yeah, so lovely presentation from Saurabh bhai, and it's always very insightful when I listen to him.
Thank you very much.
So, Saurabh, this particular slide, I just wanted to ask you.
Vivi, can
Since
you
you are
speak up a bit? I am not able to.
okay,
Voice is not there.
listen,
Yeah.
one second. Yeah, can you hear me now?
Yeah,
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 better.
right.
Okay. So this particular slide, you have ranked the factors, say in say just to take an example, in 2024,
Mm-hmm.
your alpha factor performed the best, then came in value, and then came in momentum, and then you have put in Nifty 500. So basically, momentum, value, and alpha outperformed the benchmark, and quality and low volatility underperformed the benchmark. Right?
Right. Because 2021 was a trending year, right? So after March 2020 till
Hmm.
2021 October, we have seen that there was a predominant bull market phase, right? So that is why this phase we can see the alpha, momentum, and value has worked better.
Okay. So, I mean, just looking into 2005 and 2023, what I can see is that, say, 2005, I mean, all the 4 factors outperformed the benchmark. So it was a very, it was a quite an amazing market that time, I suppose.
So if you come from that phase, you see till 2003. After 2003, the bull market started, right? That is how it
Hmm.
happened. If you go
Yes.
back. Now, these factors, when they're outperforming, you have to also see that these are not isolated events. They are also, the portfolios are also coming from there. So that is why
Hmm.
we can say that these factors are outperforming. The low volatility phase being, I think, because of the, yeah, that is it. Like most importantly to understand that low volatility is outperforming, but because the stock picking must have been that way in that
Oh.
category.
And in
And
2022, I mean, only value outperformed, right?
22,
So,
right?
yeah,
Yeah, so 22 was a sideways market, right?
that's correct. Yeah.
And that is why we can see that Nifty only value is outperforming in a sideways market, because what
Hmm.
happens in the value category is that you're trying to pick stocks which are doing good in the, you know,
Yeah.
kind
Long
of
term.
being coming from the bottom.
Yeah.
So that is why we can see these factors are not performing that well, because obviously in a choppy market, momentum factor is going to get thrashed, right?
Correct.
There will be more whipsaws in a momentum factor. Same with the
Hmm.
alpha generation. But a value factor is going to prevail because it's a choppy market. Actually,
So,
what Vivek Bhai is asking is more relevant. The point I was trying to make here is more relevant to that. Is that to understand what factor fits which market regime, right? So the regime was sideways, and that is why value worked,
okay. Yeah.
right? The regime was bullish from this till this, and obviously you have to understand these factors. This ranking which we have done here, right? They will also carry the effect of the previous year.
Hmm.
So the markets are not like 2020 से इतना तक ही वो उस phase में रहा है and 2021 में इतना phase में रहा है. This bull market phase was from March till October of 2021,
Hmm.
right? And then it entered a sideways phase. Again, if you see 2023 was bullish, but it didn't start right away, right? It was half 2024 and half 2023. And that is why we can see the alpha is outperforming in 2024,
Hmm.
right? Momentum is outperforming in 2024. Am I
Correct.
making sense? Like, is it
Yeah. No, it's
conveying the
perfectly
point?
making sense. Perfectly making sense. So, in short, I think, Saurabh, we can say that all these factors that you have showcased there, each and every factor has a certain kind of, cycles, right?
Definitely,
I
definitely,
mean,
definitely.
they have their own rhythm. They have their own cycles, right?
Right,
So
right.
they also move in a different fashion every year by year by year. Correct.
And they're all market regime dependent. So this regime which I was talking about, that is what
Hmm.
it is going to be dependent on.
Correct. Thank
And
you, sir.
that is why we do not have a holy grail factor which works
Hmm.
across.
Okay. Just one more thing I wanted to ask you, since you spoke about volatility and
Right.
you have earmarked, say, a factor called volatility. Now, sort of by volatility of stocks keep changing. So obviously the universe that we have, say, in 2025,
Mhm.
it will not we will not have the same universe for volatility. The ranking is going to change. Everything is going to change because
So
volatility
for
keeps changing.
that reason, you can do normalization of data, right? If you
Hmm.
take ATR and do a Z-scoring, or you can use a mean max scaler, right, in Python,
Hmm.
that will help you normalize the data. Now, after normalization of the data, it will be equal across the segments.
Okay.
Yeah.
Thank you.
Thanks, sir. This one message from Shekhar. First of all, I did like to thank Mr. Sovet and Mr. Saurabh for their valuable insights today. Saurabh, if you don't mind me asking, are there any guidance, book or courses you would personally recommend for anyone who wants to catch up with your level of trend following expertise?
Okay. So if you ask me books which have helped me a lot, Stock on the Move, I have already shared the name, right? One book which helped me a lot was Market Wizards. Like, it's a cliche, but um, it's not the level of understanding, rather the mindset which I have been able to develop because of the guidance, which got me here. It's totally dependent on the mindset. And other than that, uh, look into momentum, right? Momentum and volatility are two factors which are not studied well. I think there is a paper by Titman where he has called momentum as an anomaly. So go into them, do read research papers, because and if you ask me about books, books are not my contributing factors. Rather, what has contributed to this, whatever level of knowledge I have been able to gather, are running simulations. When I have taken the factors and run backtest, that is how I've learned that this fails, this work, this doesn't. So books will be something which will give you theoretical knowledge, but application of that theory is what is going to take you there. So what I would suggest, do not focus on just books, right? Take ideas, apply them, see how they fare through the market conditions, and learn by applying. That is how I have reached here.
Perfect, sir.
Hey, Saurabh, this is Srikanth. Can I ask a question?
Yes.
Yes, sure.
Hey, one wonderful analysis on this top 6 factors.
Thank you.
I have a two-part question. One, if you see in this chart, momentum is the second or third important factor from 2011 till now, 15 years, right? Second or third. What do we infer from that?
We can infer that which phase are you talking about? This
2011 till 2024.
2011, right? Like it has been rising. That is what you're trying to say.
Yes, momentum has always
It's
stayed
either been
second
out
or
the second or third.
second or third.
Hardly it has gone to fourth and fifth.
See,
Yes.
it is. You can see this is corresponding to the market behavior also, right? It is corresponding to the market behavior also,
Yeah.
right? If I take you to this chart, you will understand. See,
Okay.
2000. I don't have the data for 2011 with this because small cap started in this territory, but you can see 2018 momentum was not the top factor, right? Come 2018,
Yeah, it dropped a bit.
it dropped. But before that, we had a trending market,
Yes.
right? And thus, because we had a trending market, which is very evident from here, right? Quite evident, the small cap is rising, the mid cap is rising, and the large cap is underperforming these two categories.
At the peak of bull phase, right?
Right? So that is why momentum has fared better.
Right.
Come the bear phase or a sideways, so momentum factors are gonna suffer in bear market and your sideways market. Right? So when you do a test and if you do a win-loss, win probability and a loss probability, you will see if you have a probability of let's say 60-64% of winning and the rest is losing probability. So that losing probability plays out when the market is either sideways or falling.
Right.
Right? And when the market is bullish, the winner probability plays out for you.
Okay. So it looks more like a leading indicator.
Which one?
Momentum. Momentum looks more like a leading indicator.
Momentum is more of an anomaly. Like exactly what why it works, there is no definition to it.
Okay.
But it do work in the stock market. In the sense that in the cash segment at least, momentum works really well as a factor.
It's what I would answer this sort of is that momentum works because of equity being an earning asset. I always say this, right? Because it's an earning asset. Say companies are doing business to make profits, right? And their valuations are increasing because of these added profits every year, right? So this has to incorporate into the price of that security. Either they give back a dividend, so that then the profit is taken out, right? If they don't give back the dividend, and this profit is like accumulated, it's like compounding effect is happening within it, because that profit is getting accumulated inside the company. They are using it again to make another factory, another product, whatever, right? And that is multiplying multifold. It has got an exponential effect, and that exponential effect, that is why we get surprised that okay, equity market can go higher so much, right? People said something that a stock has become multi-bagger. It is, the reason is this only.
Makes sense.
Definitely, sir. The earnings trends are followed by earnings and vis-a-vis. Like it works that way. If there is earnings, then definitely we can see the trend rising. And obviously, there is the herd mentality which plays out also here in a few categories. So that is another factor which helps us out.
So herd mentality is correct, but understand that herd mentality cannot push the price tenfold, 20-fold, 100-fold, right? It
So,
can push to some extent,
correct me
right?
if I'm wrong, sir. I see the market trend in 4 phases, right? First, it consolidates. Then there is a breakout. The second phase starts. The third phase, the second and the third phase. So the third phase is the where mostly retailers are entering the market. Right? If you
Right.
see here also, large cap, the movement in the mid cap has started early, right? But the
Yes.
large cap is underperforming, and
Right.
the small cap is underperforming the large cap. It should have started.
Right.
But if you see,
Right.
the small cap participation mostly comes in the third phase of the market.
Yes. It's the
Like
last. It's generally
it's the
comes in the
last
last
phase.
phase, but it is vertical.
Yeah, it's vertical. It stays for a short while, right? It stays for a short while, and then it cracks.
Right.
The peak of the peak of a bull market could be very well defined by a small cap rally,
Yeah. If you
right?
will find like here, okay, generally like this phase, when the small cap is outperforming all other, okay, this is a phase where you should be careful, right?
Right,
Right
right,
now, we don't know what will happen in the future, but suppose if this starts to rise and it surpasses mid cap and then say outperforms the mid cap also, so it may continue for another say 1 year or so, but generally that will be the last phase.
right. Like
Okay,
if
it
I
is
have
generally this.
data,
What you have seen, this is a perfect, a very good example. If you see, the first leg, what you can see is that the large caps are outperforming. In the
Mhm,
second leg, the mid caps are outperforming, and in the third leg, the small caps are generally
exactly,
outperform. So
exactly,
the what I would also add here is that the uh, data what you have seen before, like go back if you can see show that slide where you say that the large caps are the best performers, right? And the
mid
small
cap is
caps
the
are
best.
yeah, sorry,
Yeah,
the mid caps
the
are the
risk
best performers,
profiling which I've done,
and
right?
small cap
Risk one.
is not that good, right? Although they are better than the large cap, they are still at par. This will rise, and this will go more than this mid cap performance in the last leg. We have
Last
not
leg,
seen the
right?
last leg. Maybe in this rally from 2020, maybe we have not seen the last leg. We may still see the last leg going forward, maybe in the next 2 years. I don't know that. Okay, but if that happens, then you will see that this, because of this excess risk what we are taking in the small cap, you will get that excess return in the small cap also, which you are not able to see as of now. This data is incomplete, maybe. Okay, because we are starting it from 2016 only. Okay,
Yeah,
maybe
because the
we will
small
see
cap,
this
yeah,
because
small cap
always higher risk
was
will have
present.
higher return also, which is not seen here.
Yeah, I agree, sir. I agree because we can see the same thing. Like if we could have gone back in history, but here also we can see when the small cap started outperforming, although it was a impact of SEBI regulations, this
Right.
2018, but still, like just to infer some idea from this, we can say that definitely the last leg of the rally is always sustained by the small caps, and that is when the bull markets are tanking.
Right. And see, understand that regulators are the last people to act.
Right,
Right. So
right.
as of now, because we have this ASM and all those rules, small caps are not able to show you the performance because of this limit rule that they cannot move more than 5% in a day, more than 10% a day. Generally, as soon as they do that, they will go into that ASM category, right? Because of that, maybe this is not showing. But uh, going forward, maybe after some time, maybe regulators will become more complacent and they will relax some of the rules, and then you will see the rally of small caps, maybe. Right? We don't know that as of
Fingers crossed, sir. Everybody
now.
wants to see that.
Yeah.
Fingers crossed for that.
Uh, uh, Shekhar is saying, you may ask what tools or programs do you personally use for backtesting and examining your trading ideas? Uh, okay, may I ask? So you can tell what tools you use for backtesting, basically.
So my favorite tool is Excel. Still, it is Excel because whenever I am starting my backtest of any rule, what I personally do is I rank stocks manually just to get the feel how the stocks are behaving or changing. And my simulation, the backtesting which I do is completely designed on Python. So the entire framework which I use is built on Python. Hope that answers the question.
Yeah, I think it answers. Okay, anybody has any other questions or we'll wind up for the day? No questions? Okay. So as we draw curtains on this insightful session, we extend our heartfelt thanks to each one of you for joining us this evening. And a special note of gratitude to Mr. Saurabh Banerjee.
Thank you so
Your
much.
structured insight, real world clarity, and strategic framework have not only enlightened but empowered us from demystifying universe selection to blending factors and risk symphony. Your guidance today has been nothing short of masterful. To all our attendees, thank you for your time and your questions and your commitment to smarter investing. We hope today's session has sparkled new perspectives and will serve a cornerstone to your portfolio journey. To listen to the recordings of this session and all of our past webinars, you can subscribe to our YouTube channel so that you can also get the notification of the future videos. Okay, you can check the YouTube link in the chat box. We have already put that. It is YouTube/trading_heads. Stay connected with us at Trading Heads, where knowledge meets practice and CMT minds sharpen market wisdom. Until next time, trade mindfully, invest strategically, and you may and your portfolio may reflect both discipline and vision. Good night, and see you in the next episode.
Uh,
Thanks a
I
lot,
have,
Saurav.
yes, sir, I have few things to add here.
Yeah,
I really thank the participants for taking out this time. The evening could have been spent in much better ways. So I'm really glad that you are here and spending your time listening to me. Thank you, sir, for giving me this platform. Like it's a real big opportunity for me, and I am glad I am there on LinkedIn. You guys can anybody you have any questions or anything regarding markets. I'm really enthusiastic about it. Just throw questions over there. You can do that and thank you for this evening. It was a great time I had with every one of you.
thanks a lot, Saurabh, for accepting our invitation for a very short notice.
Always,
I
always.
remember I gave you very little time to prepare, and you were ready to do that. And Suryas is asking, can you share how you started your Python journey?
Python journey. Python journey. So it's a very funny story. I used to do backtest manually in Excel, right? Create portfolios each month, and I used to do backtest manually since 2000 using technicals. It was a gruesome, excruciating process. With time, I gradually picked up the speed, but it used to take me like a week to backtest a single strategy. From there, I my motivation was just to make my work simpler and automated, right? So that is how I started implementing Python, and why I actually started my algorithmic journey with Ami Broker, but I shifted to Python because Python gave me the flexibility of implementing any idea I come up with, right? So that is how I got started. It was a very simple thing just to automate the process of backtesting. Yeah, and you can and to be honest, like I never took a course or anything. It was all self-learned. I used mostly YouTube channels. There are many great courses on Stanford. Check out CS5. It's a really good one. And there are many good courses on. I think Skinner has a good course on Python. And yeah, it was like that. And taking few help from a few of my developer friends who help me out understand and guide me through the process. That's it.
Okay. Uh, that was great, Saurabh. You have self-learned Python is a great thing. Generally, people don't do it, right? Okay.
It has to be so. Like
Anyways,
everything needs to be self-taught if you need to do something. The passion, I think, passion will give you the motivation to self-learn things.
yeah, I remember 2018 when you came to us and we were discussing. Okay, I can see the passion on in you on that word very day itself. And I remember when we were doing level 2 classes, I think some days you were alone as a student, right? And we used to talk a lot in those periods, right? So that in that phase also, I understood that this is you have so much curiosity to learn. That was something amazing to see.
And sir, I was also lucky to have a mentor like you. So it goes both ways. That you are entertaining my questions because they were quite like in the beginning they were quite stupid. But yeah, thank you for entertaining those questions.
I know they were not stupid. And sometimes I was also getting confused of what should I answer because I may also not be knowing the answers of some questions, right? Okay. Anyways, let's wind up here. Okay. Thanks a lot, everybody, for joining. Okay. And we'll see you in the next webinar. Next will be on 29th May. Okay. Next Thursday. And we will have a renowned speaker there. And also stay tuned for 5th June session, which will be where we'll be having Mr. Perry Kaufman as a speaker, right? So I've been a big fan of Perry Kaufman.
Really?
Uh,
I need to
we,
attend that.
yeah, I think we
Learned a
all,
lot from. So Srikanth was actually asking about a book. Do look Perry Kaufman's book. Like it's a library of ideas. It's a library of ideas. I just forgot, but yeah, thank you for reminding me. It's a library of ideas.
and that person himself is like a god to us, right? I think so. We have learned so much from him. At least I have read his book at least 20 times, and still I find something new in it. Okay, so don't miss that episode. At least 6th June. I know a lot of you may be having your CMT exams also. It's coming very closer to the exams, but I think you should not miss that. Okay, fine. We'll wind up for the day. Okay,
Good
thank you,
night,
everyone.
guys. Have a good time. Thank you.